All right, let's get right into it. The big question for today is this. Is your risk profile, the way you're set up to handle risk, actually holding your investments back? Is it costing you big time?
Have you ever really thought about this? It's kind of a puzzle, isn't it? You see two people, maybe they even work together, earn pretty much the same salary, but fast forward 20 years and one of them is set for a great retirement, while the other is, well, they're really struggling. What's going on there? What's the secret ingredient?
Well, here it is. 9 times out of 10, it boils down to this single thing, a mismatched risk profile. It's not about being lucky or having some secret stock pick. It's about a total disconnect between how old you are, what you're saving for, and the actual risk level inside your investment portfolio.
So let's talk about that mismatch problem, and specifically the incredibly high cost of being too safe. Okay, here's the trap, and we see this all the time, especially here in South Africa with retirement annuities, RAs. Picture this. A young person, maybe 25 years old, starts their first job and they're RA. They get put into the standard default low-risk fund, and then they just forget about it. It's like trying to win a marathon by deciding to walk the whole way. You're just not going to get there. So what's actually in one of these safe funds? Well, it's mostly cash and bonds. And yeah, that feels really secure, right? But here's the thing. They have a silent killer working against them, and it's called inflation. Over the years, inflation is like this quiet thief just constantly chipping away at the real value, the purchasing power of your money.
And here's what that looks like in real numbers. This 3.1%, that's the latest inflation figure from the SA Reserve Bank. So think of it like you're on a treadmill that's moving at 3.1%. Your investments have to run faster than that just to stand still. If they don't, you're not just failing to get ahead, you are actively moving backwards. You're losing money.
Okay, so to fix this whole mismatch thing, we've got to understand the basics. Let's talk about the rules of the game.
So what even is risk tolerance? Well, it's really made up of two key things. First, there's your ability to take risks. That's the numbers part, your age, your income, how much you have saved up. But then there's your willingness to take risks. And that's all about your emotions. How do you feel when the market drops? Do you get that knot in your stomach? Do you feel the urge to just sell everything? For a plan to work, your head and your heart have to be on the same page. Now, specifically in South Africa, if you're saving for retirement in something like an RA, there's a rule you need to know about called Regulation 28. The easiest way to think about it is like guardrails on a highway. They're there to keep you from going off the road by making sure your money is spread out and not too concentrated in any one risky thing. It's a built-in safety net. And here's a look at what some of those guardrails actually are. See, even if you want to be super aggressive, Regulation 28 says, nope, you can't put 100% of your retirement money into shares. You can see the limits right here, a max of 75% in equities, 45% offshore, and so on. It forces you to have a mix, which is generally a good thing for safety. Okay, knowing the rules is important, but using them to your advantage, that's the real secret. And let me tell you, your biggest asset, your real investment superpower, isn't money. It's time. You have got to get this into your head. It's a total game changer. When you're investing for the long haul, the day-to-day market drama, that volatility, it's just noise. The actual danger, the thing that should keep you up at night, is your money not growing enough. The biggest risk is playing it so safe that you end up with too little when you actually need it. This life cycle chart shows it perfectly. Look, when you're young, you're down here in what we call the accumulation phase. Your one and only job is to grow your money. It's not about protecting a small amount, it's about making that amount as big as possible. You want that curve to be steep, shooting upwards, because you have decades to ride out any bumps in the road. That's where the magic of compounding really kicks in. Still not convinced? Wondering how you get that growth? Well, look at the numbers. This data shows that equities, shares in companies, returned over 18% per year for the last 3 years. And what was inflation doing? Just 3.7%. That's not just a win, that is a knockout. You're not just keeping up, you are lapping inflation over and over again. That is what creates serious wealth. All right, that's the theory. So how do we make this practical? Let's talk about what your risk profile should look like at different stages of your life. You can really think about your investing life in 4 basic chapters. You start out aggressive, taking on high risk, and then you slowly, gradually dial it back as you get closer to retirement. Okay, first up, your 20s. If you're between 18 and 30, your focus should be on one thing and one thing only, building wealth. This is when you should have your foot on the gas. That means being invested heavily in equities, both here and overseas, right up to the legal limits. A market crash? Who cares? You've got decades to recover. It's all about growth, growth, growth.
Now, what about your 30s and early 40s? Well, life starts getting a bit more complicated, right? You might have a bond, maybe kids, more responsibilities. You're not taking your foot off the gas completely, but maybe you're easing up just a little. You're still focused on growth, but you start to blend in some more defensive stuff, just to make the journey a little less bumpy.
Once you hit your late 40s and move towards 60, you're really shifting gears. Think about it. You spent 20 or 30 years building this nest egg. Now the main job is to protect it. You're not ditching growth entirely, but you're definitely dialing back the risk and bringing in more stable investments that are less likely to give you a heart attack.
And then 60 and older. This is the finish line. You've made it. You're now officially in the spending phase. The whole point of your portfolio has changed. It's not about making you rich anymore. It's about keeping you rich. Its job is to give you a stable, predictable income so you can actually enjoy your retirement. It's all about capital preservation now. Now, understanding all these stages is so important. Why? Because if you're not paying attention, you could be falling into a massive trap, one that costs South African investors a fortune every year, the RA trap.
Just look at this. On the left, you've got the typical default fund your RA gets dumped into. It's low risk, full of cash and bonds, and has low growth potential. On the right, you have the fund a young person should be in, a high-growth fund full of equities. The difference between these two paths isn't small. We're not talking about a few thousand rand. Over a lifetime, this is a multi-million rand decision. It's absolutely huge.
Okay, that was a lot. So let's boil it all down. What are the key things you absolutely need to walk away with?
Here's your action plan. Number 1, understand that your risk profile is what drives your returns, period. 2, being too conservative when you're young, that is the biggest risk. 3, your IRA is absolutely not a set it and forget it kind of thing. You have to manage it. 4, your risk level isn't static. It must come down as you get closer to retirement. And finally, remember that the best strategy in the world is useless if you panic and sell at the wrong time. It has to match your emotional tolerance too.
So I'm going to leave you with this one final thought. Take a hard look at your investments and ask yourself this honest question. Is my portfolio built to take advantage of my timeline, or is it really just built to calm my fears? Because how you answer that could change everything.